Hello! I don't think anyone could deny that these are strange and challenging times indeed. So much so that I can't work from my normal studio. So, for the next few videos, I hope you'll forgive me not appearing all the way through. That may be a bonus, as much as a drawback, but you'll get my audio and you'll get my normal slides, plus a contact point where you can raise any questions. I hope you still enjoy the videos, and once we're through this crisis, I look forward to rejoining you from the usual spot. Welcome to this Skillick Explains. This time I want to take on investing errors, and 5 worth avoiding at any time, but particularly during this lockdown period. So the background would be what? Well, I don't need to tell you that lockdown rules have transformed normal life for most people. A lot of people have a bit more time on their hands and are wondering what to do with it. And whilst that's great, in an environment where the stock market is highly volatile, it can also be a little dangerous. This is exactly the sort of environment where people make mistakes, and I want to cover 5 that I hope you will avoid as we travel through lockdown. Number 1 is gambling when you used to be an investor. Now, what do I mean by that? Well, essentially, there are opportunities out there, or so it seems. In some asset classes, price swings of 5 to 10% are happening in a matter of hours sometimes. And the oil market's a case in point. A contract called WTI actually suffered negative prices after a price drop of 34% just in one day. Prices went negative. And meantime, other prices, gold, Bitcoin, equities, swinging all over the place. And this can create a bit of temptation, especially if you're watching the news headlines. I'll come back to those in a moment. Don't be tempted. And here's why. Basically, if you look at the oil market, its dynamics are complex. So it may be about demand and supply, most markets are, but underpinning that are some complex forces. And playing oil is therefore not straightforward, either in terms of understanding the market or the products. So for example, if you don't know what an oil future is, you're not going to stand a lot of a chance with most of the products out there that claim to play oil. And massive volatility is therefore only an opportunity for those people who know what they're doing. And I suspect if you haven't played the oil market before, now is not a good time to start. Anchoring is number 2. Now, in an uncertain world, our brains are wired to look for reference points, look for things we can get hold of, look for benchmarks. And if they don't exist, our brains will create them for us. And this isn't helpful as an investor. Now, good examples of this would be what? Well, saying things like it can't go any lower. Or I've heard people say interest rates and oil prices can't go below 0. Oh yes, they can. When I get back to what I paid, I will sell, but not before. Why? What if circumstances have changed? What if you're waiting a decade for prices to get back to what you paid? What if what you paid was, in hindsight, a bit of a mistake? This is a classic pattern, people say. It might be, but relying on the past to guide you in current markets can be risky, and relying on published strategies to take you into the future are by definition risky, because those are strategies that did work once but may not work in the current environment. So beware of anchoring. Then there's herding. Now, we look for confirmation of what we're doing. We like to see other people behaving as we do. And that's natural. That kept us alive on the savannah. But in the stock market, it can be dangerous. So when everyone is selling, it's tempting to do the same thing later than most of the big movers. And vice versa. We see stocks bounce and we think, oh, opportunity to get in, recoup some losses. But the reality is, if you follow the crowd the whole time, you are programmed to buy high and sell low, the exact opposite of what you want to achieve. So herding is something to avoid. Now, overreacting is number 4. These are all connected. We're programmed to act and react to news. We're programmed to do things, to move money around. And we're not helped by the fact that sales folk, the media, and chunks of the financial services industry all know this and encourage it. So the key is to recognise that sometimes doing nothing can feel difficult, can feel hard, but it is the best option. As one colleague put it, your pension portfolio is like your face. Don't touch it. Finally, self-flagellating. These are difficult times, and hindsight is a wonderful thing when it comes to managing a crisis. Yes, Bill Gates did see something like coronavirus coming, but a lot of people didn't, or a lot of people thought the risks weren't as high as it turns out they actually were. With the financial crisis of 2007-2008, a lot of people said, yes, we could see that coming, but hindsight really is a wonderful thing. And a lot of people do beat themselves up when actually most of them didn't see this coming, and in human terms, that was not unreasonable. So avoid regret, avoid looking backwards too much, avoid words like should have sold more then, should have bought more then, and have a bit of faith in your long-term plan, and try not to be blown off course by what's happening right now. This too shall pass, we just don't know how quickly. Any questions on those 5 errors, or indeed any other errors you might be tempted to make, tim.bennett@killick.com, and to watch related videos, I would suggest you go to killick.com/learn.